The deficits have been a pretty big part of my analysis. The short answer is I expect this to go on for quite a while. I kind of view that nothing really stops this train for the next 5, 10 plus years. That this is going to go on for quite a while. Large background structural deficits, which then adds to nominal GDP, on average adds to inflation, but again, not evenly. So obviously technology makes things cheaper. Other things can make things cheaper, but on areas that are not offset by those, you can get pretty high inflation.
Structural deficits are reshaping the global economy, driving inflation while propping up nominal growth. Over the next 5 to 10 years, this imbalance is expected to persist, boosting asset prices and creating a divide. Tech-driven sectors thrive, while housing and tangible assets face steep cost increases. Bitcoin, hitting record highs in 2024, benefits as a store of value in this inflationary environment. As markets evolve, adapting to these economic shifts will be critical. Watch highlights from Lynn Alden's interview for more insights, and don't forget to like, subscribe, and turn on notifications. Enjoy the video.
The potential for a debt ceiling issue and the associated liquidity effects of that debt ceiling issue. So historically, there's somewhat counterintuitive effects of a debt ceiling. When the debt ceiling gets put back in place because some prior agreement has expired, which is going to happen here in January. The ironic thing is that for a while, it's actually good for liquidity for not a great reason. Basically, that they're stuck, they're not able to issue net new debt, but they're still running deficits. But the government maintains a cash balance at the Fed called the Treasury General Account. And so what they do is they start spending that down back into the economy. And during the multi-month process that's happening, that's actually good for liquidity, ironically, until they basically, either run out and default, which hasn't happened, or until they come to an agreement at the 11th hour and then start refilling that cash account, which is generally negative for liquidity. So I was monitoring that there's probably a higher chance of a debt ceiling cash drain if you get a Harris victory, because historically, the Republicans have used that tool against Democrats' administrations more than the other way around, at least given the decade and a half sample size we have of that tool being used for that purpose. So I think that the Trump win reduces the probability pretty significantly of that debt ceiling being a material issue, and therefore removes that kind of liquidity tailwind that might have otherwise happened, ironically, in the first 6 months of next year. Other things that pertain to the deficit as a whole can impact almost every sector. This is kind of offset partially by the fact that the Republican Party does have a platform for 2024. So we can see like a list of expectations that they lay out. And for example, I believe from memory, Promise 14 in the 2024 Republican platform was not to cut Social Security or Medicare and not to raise the retirement age, which is very different than the Republican politics of the 2010s, the Paul Ryan era, which was that those programs were kind of priorities to trim. And so the Democrat position was don't cut them. The Republican side was we need to trim and trim these. And now, at least in that specific area, the Republican side is kind of like how the Democrats were in years prior. And obviously the Democrats don't want to cut those either. There's kind of this like locked in spending that I think is pretty much baseline regardless of the election outcome that we now have. But then the specifics of things like tariffs, immigration or deportation policies, and then for specific sectors, like in terms of either food companies or healthcare companies, obviously, the Health and Human Services Department, it could be quite impactful. I think it's then partially slowed down by things like lobbyists. Kind of again, there's like in any administration, there's a gap between desires and then what is actually happening when all the real politics comes into play. I mean, in the initial Trump administration, he said he was going to eliminate the national debt, and then we added $8 trillion to the national debt. I think pretty much regardless of who you get, you're going to add to the national debt. And so I think there's obviously, but there is a bigger than normal variance here because of some of these picks that are different than picks we've seen in, say, the last 3, 4, 5, 6 administrations. The fiscal deficit has been a core part of my investment thesis since at least 2019. And that's when I viewed that the US was entering fiscal dominance, which is to say that fiscal deficits becoming an increasingly large part of economic analysis and investment outcomes. And that's for a couple of reasons. One is that the baby boomers entered their kind of retirement years. And so the entitlement systems kind of hit an inflection point where they became more top heavy. And so they added to the structural deficit in that sense. And then two, we've had 4 decades of rising debt, but falling interest rates. And so if you double your debt, but you cut your interest rates in half, you maintain your interest expense pretty manageably. And now, when interest rates bounce off zero and then even went up, but let's say they just trend sideways for the foreseeable future, you no longer have that offset. So you're getting higher and higher debts, but you're not offsetting that with lower interest expense anymore. And so you start to get something more akin to a slow motion fiscal spiral. And so I've been of the view that the large deficits, I wrote about this back in 2019, 2020, 2021, that they would be inflationary. They were. And now I've been more of the view that, okay, we're past that big weight, that spark of inflation, but now things are going to run hot on average more than people think, which is that, whenever there's kind of a borderline recession, I would err toward it's still running hotter than people think. So less deep recessions, less deflationary recessions, but on average, a little bit higher inflation and a little bit more kind of dislocations. Because, if a person or an industry is on the right side of those deficits, if they're directly or indirectly receiving those deficits, they're probably doing pretty good. On the other hand, if they're not on the receiving side of those deficits, there's a better chance that they're struggling. And so the deficits have been a pretty big part of my analysis. The short answer is I expect this to go on for quite a while. I kind of view that nothing really stops this train for the next 5, 10 plus years. That this is going to go on for quite a while. Large background structural deficits, which then adds to nominal GDP on average as to inflation, but again, not evenly. So obviously technology makes things cheaper. Other things can make things cheaper, but on areas that are not offset by those, you can get pretty high inflation. You can get asset price inflation. You can get real estate inflation. You can get tariffs. We'll see what happens there as supply chains. We've had 40 years of globalization, which helped offset some of the, inflationary effects of monetary expansion. Those are probably at least going to be slower going forward, let alone the potential for some of those reversing. And again, globalization has winners and losers, but generally the CPI is one of the winners. That it kind of reduces otherwise what CPI could be, because you're basically connecting Western capital with Eastern labor. When China opened up to the world and the whole Soviet bloc opened up to the world, this was a productivity boom globally. And that's kind of over, or at least, in terms of the magnitude, it's kind of over. It's kind of already done, and it has a potential for a reversal. So those are some things I monitor. To use the fact that I'm in Egypt right now, I come here every year. I have a second home here because I have family here. And last time I was here, they were dealing with 40% inflation. And life looked similar to how it looked when they had 10% inflation. People tolerate kind of background things. Like people in the US wonder what's going to happen when this kind of runs off a cliff. And my view is generally it takes on increasing emerging market characteristics. It doesn't just turn into Venezuela overnight. It's basically this background nominal deficit fueled, somewhat inflationary component.
Lynn Alden explores how structural deficits are shaping Bitcoin's trajectory into 2025, linking rising deficits to demographic shifts and higher interest rates. While debt ceiling debates provide short-term liquidity, subsequent tightening creates market challenges. With fiscal dominance persisting and globalization slowing, Bitcoin emerges as a hedge against economic instability. Alden highlights the US dollar's central role, with $13 trillion in dollar-denominated debt fueling inflation through fiscal deficits and monetary expansion, indirectly supporting Bitcoin as an alternative store of value. As nations like China push toward a multipolar financial system, Alden warns that easing credit cycles could trigger a second inflation wave, further boosting Bitcoin's appeal. Watch more insights from the interview.
Let's watch more clips from the interview.
I think the US is, especially because they're starting from a more developed capital base. We can also look at the fact that there's about $13 trillion of dollar-denominated debt in the world that's outside of the US. And it's not even owed to the US for the most part. It's like owed to other countries. Like, for example, a country in South America or Africa will owe dollars to China, for example, or Europe, or some entity in Europe. And this big intertwined Euro-dollar system and global capital dollar lending system, all that debt represents inflexible demand for dollars, which is actually currently bigger than the monetary base of how many base dollars exist. There's more inflexible demand for dollars than there are base dollars. So I think basically you get in the future a lot of money printing, a lot of monetary expansion to support the deficits. That does come with inflation, but it also does have a pretty long runway of demand for that currency. I like assets like gold and Bitcoin better than I like dollars in the long run, and equities and high quality real estate. But I think that kind of monetary inflation, partially fueled by fiscal deficits, is probably going to be something we're going to be talking about 5 years from now, 10 years from now. That the global monetary system is going to become a little bit less unipolar. It's been quite unipolar ever since the post-World War II environment, first the Bretton Woods system and then the petrodollar, eurodollar system. Back when that was formed, the US was over 40% of global GDP. And they had the biggest intact manufacturing base, they had the biggest military base, and every metric, it was very concentrated. As the world's recovered from that, and from an era of communism and colonialism and then wars and all that, we have a different world now. China has the biggest industrial base in the world, but they're behind in other categories. We have a little bit more of a multipolar world, in other words. And we've also had a hollowing out of the US in part because of the monetary system, which is to say that when the whole world uses dollars, the way that the US supplies those dollars is by running structural trade deficits for the most part. And that's kind of an automatic thing that happens. Basically, there's extra demand for dollars, which increases the strength of the dollar kind of artificially. So a lot of currencies kind of in the long run trade based on their trade balance, which is that if you run structural trade deficits for a long time, eventually you have a currency devaluation and kind of finds an equilibrium. But the US never really finds that equilibrium because we have this extra layer of demand for dollars and treasuries and equities and things like that, because it's the most recognized and most liquid ledger in the world. So when South Korea and Brazil, when those corporations make a contract, it's often in dollars instead of their own currencies. And I think that as the BRICS kind of face increasing frictions from that, as they become a larger share of global GDP, they want to naturally untether themselves from the dollar, at least partially. And in the US, we see things like, they want to reshore things, but that's hard to do with the system structured as it currently is. The part that I take seriously about the BRICS is the trade agreements and the kind of the bilateral currency trade agreements. So I do think that China is going to be increasingly successful at buying things in its own currencies and having some of its trade partners be willing to hold its bond for short intermediate periods of time, because they know that they can trade those bonds and currency units for a lot of goods that China makes. China is now the biggest trading partner for most countries in the world. If you look at like the senior loan officer surveys in banks, for example, whenever you see like a really big percentage of them say that they're tightening credit, especially when you get like over 40% of them saying that they're recently tightening credit, over the past 30 years, that's been associated with a recession. And so in 2022, and then extending into 2023, if you just looked at loan creation and senior loan officer surveys around tightening credit, if you just kind of put your blinders on and looked at those metrics, it looked like a recession. If you look at things like the misery index, which is the sum of unemployment and inflation, 2022 reached recessionary levels. And yet we didn't have a labor cycle recession. And the PMIs, we've had kind of a record amount of time with contracting purchasing managers indices. So PMIs below 50, normally that's been associated with recession. So we've had a number of these recessionary indicators, including bank lending, which historically has been very important for the credit cycle. And yet we've not officially had a recession. And, I've argued that a large portion of that is because we're in fiscal dominance now. So if you look over the past 70 years, and I've published these charts on this, historically bank lending, like the annual amount of new bank loans created, is bigger than the annual deficits, usually. And the kind of the brief exceptions for that for most of the past 70 years were briefly during recessions, because you'd get a reduction in bank lending, you get an uptick in deficit spending, and there were these kind of brief, maybe 1 year windows where the deficit would be bigger than the amount of bank loan creation that year. But in recent years, we've had fiscal deficits exceeding bank lending, even in non-recession environments. Like you have multiple years in a row of just deficits are bigger now. Bank lending, even though it's really sluggish over the past couple of years, and credit availability has been pretty tight, especially for smaller businesses that are more reliant on bank loans and less reliant on capital markets for borrowing. That has been a pretty friction-filled area, but it's not been enough to slow down the economy too much because we have these large background fiscal deficits, which are kind of supporting parts of the economy. Even as simply as, Social Security is going out and then people are receiving it and spending it on things like travel. One of the things I'm kind of monitoring is that we are seeing signs that the credit cycle might have bottomed, that they're not really tightening at the rate that they were in 2022 and 2023. There's by no means any sort of credit boom happening, but sometimes reversals are the most important areas.
The global financial landscape is shifting, with Bitcoin at the center of transformative discussions. A VanEck report suggests a U.S. Bitcoin reserve could reduce national debt by 35% by 2049, assuming Bitcoin reaches $42.3 million per coin. Lynn Alden highlights Bitcoin's potential as a hedge against inflation and systemic inefficiencies, aligning with VanEck's vision of Bitcoin as a revolutionary asset. As global reliance on the U.S. dollar faces challenges, strategies like Senator Cynthia Lummis's Bitcoin reserve proposal reflect the push toward a multipolar financial system. Could Bitcoin help reduce debt and reshape global finance? Share your thoughts in the comments, like, and subscribe for more insights.